Welcome back to the Deep Dive. Today, we are zoning in on one specific event that really sent waves through the specialty retail sector. We're talking about the Q3 fiscal year 2026 earnings call for Urban Outfitters, Inc., or URBN.
Right.
We've got all the analysis here, and our mission is to cut through that transcript and really pull out the key takeaways, because this wasn't just a routine check-in.
No, not at all. This call, I think, it confirmed a huge shift in the company's multi-year story. The market reaction said it all, really.
That's the best indicator, isn't it?
It is. The results landed after the close, and the trading session the next day was just croat. It was a decisive, high-conviction move. It blew past what most volatility models were predicting.
So not just a small beat.
No, this was an unambiguous beat, pretty much across every single part of the business. It really proved that management strategy is, it's taking hold.
Okay, so when you see a stock move like that, a real break from expectations, the core numbers must have shocked the consensus. Let's start right there. What were the headline financials that drove this huge price action?
Well, the size of the beat was substantial, both on the top and the bottom line. If we look at profitability first, GAAP EPS, that's your earnings per share. It came in at a record $1.28.
$1.28, and the street was looking for what, around $1.18, $1.20?
Exactly, clustered right in that range.
Right.
So you're looking at a robust, 7 to 8% beat, and that's 16% year-over-year growth.
16% EPS growth is, that's excellent, especially in this kind of choppy consumer environment. What about the top line, the sales?
Net sales landed at $1.53 billion. That's an impressive 12.3% jump year over year.
And analysts were looking for?
Around $1.49 billion. So they beat the consensus by about $40 million. It's really hard to find a flaw in those initial numbers.
And the market's reaction really tells the story of the quality of that beat. We always track the implied move, right?
Yeah.
What the options market expects.
Yeah.
And that implied move was roughly 8.8%. But the actual realized move from the close before the call to the next day's close, it was about positive 13.5%.
And that gap, that's the key. When the stock moves almost 5 percentage points past what the options traders priced in, it tells you something.
It's not just shorts covering their positions.
Exactly. It confirms that genuine momentum buyers, long-term funds, they're stepping in. They're recognizing that the narrative has shifted from just a retail recovery to more of a compounding growth story. Okay,
so let's unpack this. A beat of this size means the strength wasn't just in one place. It had to be broad-based. What were the pillars driving that 12.3% top-line growth?
The strength really came from the retail segment. It delivered 8% year-over-year comparable sales growth.
Which is huge.
It is. And what's critical here is the balance. Digital comps slightly outpaced store comps, which shows that all those heavy investments in their omnichannel platform are paying off.
They're meeting the customer where they are.
Precisely, wherever they want to shop.
And this story gets really compelling when you dig into the brands, because Anthropologie is usually the one carrying all the weight. But this time the Urban Outfitters brand showed up. Big time.
It absolutely did. The UO namesake brand saw global comps surge 12.5%.
Wow.
That's their first double-digit comp result in quite some time. It's a huge signal that the multi-year turnaround effort is finally hitting, critical mass.
And what was the most surprising part of that?
To be frank, the most surprising number for me was Europe. UO delivered an exceptional 17% comp there. That momentum just validates all the changes they've made to their inventory mix and design strategy overseas.
And Anthropologie, the reliable workhorse, they just keep marching forward, don't they?
They do. Anthro delivered a fantastic 7.6% comp this quarter. This marks their 19th consecutive quarter of positive comps.
Yep.
Yeah. You just don't see that kind of consistency in the apparel world today. It proves their strategy of focusing on their own brands and sophisticated product development is just incredibly sticky with their customer.
Okay, and then you have the Free People ecosystem, which is still riding that fitness and wellness wave.
Yes. Free People itself delivered a solid 4.1% comp, but the real standout continues to be the FT movement business. It achieved 18% total growth.
And that's driven by new stores.
It's driven by expanding their dedicated store base, yes. And also by their ability to acquire new, highly engaged customers who are really buying into that whole lifestyle aesthetic.
We have to pause and talk about Nuuly, the subscription rental business. I feel like it's no longer a little side project. It's becoming a material part of the whole story.
It's absolutely becoming a core part of the investment thesis. Nuuly is transforming from a promising idea into a structural growth engine for the company.
And what did it contribute this quarter?
The revenue for the rental business jumped 49% year over year.
49%.
And that was driven by a 42% increase in average active subscribers. They're now just shy of 400,000 subscribers.
Wow.
And that growth alone, get this, added 3.5 percentage points to the total company revenue growth.
That's massive.
It's massive leverage from what's still considered a non-core retail asset.
Okay, let's shift from the top line down to profitability. This was maybe the biggest question mark heading into the call. With inflation, shipping costs, how did they manage to expand margins?
I think the margin performance is arguably what truly sold the market on this report. The gross profit rate improved by 31 basis points to 36.8%.
And just for anyone listening, a basis point is 0.01%. So 31 basis points is just under 1/3% improvement, a real win in this environment.
A definite win.
So what were the key levers they pulled to get there?
Primarily, it was two things. First, really disciplined inventory management, which led to lower markdowns. We saw this especially at Urban Outfitters and Free People.
A sign of better buying.
Much better buying. And second, they benefited significantly from something called occupancy leverage.
Let's define that, because that's a key piece of retail jargon.
Sure. Occupancy leverage is basically just a financial way of saying they spread their fixed costs like rent, utilities on their stores across a much larger sales base.
So when your comps grow by 8 or 12%, but your rent is fixed.
Exactly. A much smaller piece of every dollar in sales goes to cover that fixed cost, and that difference drops straight to the bottom line, to the margin.
Now here's where the execution really becomes clear. They did all this. They expanded margins despite a major cost headwind that hit them right in Q3.
That's the most impressive part of the story, I think. Management was explicit that tariffs negatively impacted the Q3 gross margin rate by about 60 basis points.
60.
Yeah, they're dealing with a 50% tariff rate on certain goods coming in from India. So that means they overcame a drag that was almost double their gross margin improvement.
Just through operational excellence.
Through operational excellence and markdown discipline. It's really impressive.
That puts it in sharp relief.
Yeah.
But I did notice that SG&A, that's selling, general, and admin expenses, it grew faster than sales, up 14%. Was there any concern there?
They framed it as a necessary investment, not structural bloat. The increase was heavily weighted toward marketing, which, clearly worked. It fueled customer acquisition and supported that huge subscriber growth at Nuuly.
So they're spending to scale the high growth parts of the business.
Exactly. They're deliberately pouring fuel on Nuuly, Free People, and FP movement, and that requires spending upfront to get those new customers.
Let's turn to the strategic story, and I want to focus on that Urban Outfitters brand turnaround. Moving from deep losses to a low single-digit global operating profit margin for the quarter. That's a huge milestone.
It's a massive milestone. It's a story of just meticulous execution. That profit was driven mainly by a huge improvement in Europe and really shrinking the operating loss in North America.
So this isn't just a flash in the pan.
No. This suggests the brand is now on a credible path to achieving sustainable annual profitability, maybe even as soon as next fiscal year. And that was unthinkable 18 months ago.
And the product strategy behind that?
Yeah.
They admitted they had become unintentionally niche. What did they do to broaden their appeal?
They moved aggressively into high-performing categories like denim and loungewear. And they anchored those categories with their own successful brands like BDG and Out From Under.
Right.
They realized they had to move beyond a narrow aesthetic and offer things that resonate more broadly while still, keeping their unique style. That breadth is what's driving that 12.5% comp.
Meanwhile, Anthropologie, the consistent performer, is still finding ways to innovate. Tell us about this Maeve concept.
Right. So Anthro's strength comes from increasing their own brand penetration, which hit a record high this quarter. Maeve is a perfect example of how they test new ideas. It's an in-house label they launched as its own standalone boutique in North Carolina.
And it's working.
It's exceeding forecasts with a high double-digit beat. And critically, management sees Maeve as accretive, meaning it's actually driving total store sales up across the whole region.
So Maeve isn't just a shop. It's a lab for product and real estate strategy.
Exactly. It de-risks future expansions by giving them real-world data before I try to scale something nationally. It's smart, disciplined growth.
And that discipline, you see it on their capital allocation too.
You do. They were highly disciplined. Inventory growth was at 5.9%, which they deliberately kept below that double-digit sales growth.
Which is a very good sign.
A very good sign of clean execution. And they're also rewarding shareholders, buying back about $152 million in shares year to date. Plus, their new store strategy is smart, planning 69 new stores against only 17 closures, and really leaning into those high-growth formats.
Okay, so what does this all mean for the crucial holiday quarter for Q4? What's the guidance look like?
Management is projecting total sales growth in the high single digits. They expect retail comps to land in the mid-single-digit positive range.
And by brand?
They broke it down. They see UO delivering high single-digit comps, Anthro mid-single-digit, and Free People in the low to mid-single-digit range.
But the margin story for Q4, that's going to be the real test. You said the tariff drag was 60 basis points in Q3. Management is expecting that to increase to around 75 basis points in Q4.
Right.
So how can they possibly guide for continued gross margin expansion of 25 to 50 basis points with that kind of pressure? That sounds like a big gamble.
It's a steep climb for sure, but management expressed a lot of confidence. They believe the continued improvement in markdown discipline at UO, plus that sustained occupancy leverage, will be enough to overcome that 75 basis point drag.
And if they hit that?
If they hit that, it reaffirms their full-year target of improving both gross and operating margin by about 100 basis points, which gets their EBIT rate very close to that long-term 10% target.
The conversation about consumer behavior heading into the holidays was also really interesting. They hit the promotional environment head on.
Yes. Management acknowledged a slight shift. Customers are being more deliberate. They're waiting longer to buy things because they anticipate sales.
Basically, a return to pre-COVID shopping habits.
That's all it is. And the success of their early holiday events suggests they're managing this shift well. They're being proactive instead of just reacting with desperate discounts.
And on pricing, are they just going to keep raising prices next year?
No, they confirmed they're being highly strategic. They committed to maintaining their opening price points, especially at the now profitable Urban brand. Crucially, they do not expect to need big incremental price increases next year.
So most of the price hikes are behind them.
That's the message. The focus now shifts back to cost management and volume. The takeaway is that beyond Q4, the big levers are still there. Nuuly scaling, UO improving, and occupancy leverage. The one big uncertainty is tariffs beyond this fiscal year. And now, our disclaimer. This segment is for entertainment and discussion purposes only. It should not be considered financial advice, investment counsel, or a recommendation to buy and sell any securities. Please consult a licensed financial professional before you make any investment decisions.
With that necessary context out of the way, let's look at the market positioning. This quarter delivered two undeniable structural shifts: the UO turnaround and that Nuuly growth engine.
Yeah.
So let's pitch the outrageous but plausible trade idea based on this.
Okay, the trade is built on comparative valuation. You go long URBN, and you fund it by shorting a highly levered, pure-play specialty apparel retailer.
One that lacks a structural growth asset like Nuuly.
Precisely.
So break down the rationale for me. Why that specific pairing?
Well, the market consistently undervalues the portfolio diversification that URBN now has. The short leg of the trade, that pure play retailer, is totally exposed to the more promotional environment and has no hedge against the macro consumer.
Which URBN just proved they can manage.
Right. The long leg, URBN, is a bet that the UO brand delivers sustainable annual profitability in FY27, which management hinted is possible. You combine that with Nuuly's path to 500,000 subscribers, and you have a recipe for a major re-rating.
And the stock action supports that thesis.
It absolutely does. The stock moving 13.5%, blowing past the options market, confirms the narrative has shifted in their favor. This is now a play on relative strength and a real structural advantage.
So to sum it all up,
to summarize, Q3 FY26 confirmed URBN's spot as a relative winner in specialty retail. They showed the power of a diversified model across brands, channels, and a rental service to grow revenue, deliver broad-based comps, and expand margins, all while navigating some pretty serious headwinds. The execution was just excellent.
It's a powerful story of execution and portfolio management. But given management's confidence that most price increases are behind them and that consumers are waiting for deals, here's a thought for you to chew on. Will a return to that aggressive pre-COVID promotional timing ultimately prove to be a necessary strategy to capture market share? Or will this behavioral shift become a long-term structural drag on the entire industry's profitability that we haven't yet priced into valuations? We will be watching closely. Thanks for diving deep with us today.